Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Hyliion stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Hyliion develops technology to help trucks use less gas or no gas. The company does not manufacture cars like Tesla or NIO. Its technology relies on upgrading existing commercial trucks from other manufacturers. Its focus is on Class 8 trucks, which are the big rigs, the 18-wheelers found all over our highways. These massive trucks are expensive to buy, expensive to operate, and are very bad for the environment since they emit a lot of pollution into the air. Electrifying big trucks is a win for the environment. It's also a win for the companies that operate these trucks since fuel costs are so high. The global number of commercial trucks is expected to grow to 1.4 million by 2030. The company's main product is Hypertruck ERX, which is a hybrid system that can help trucks travel for short distances on pure battery power. But it's an in-between solution, and it's not a full electrification. Using Hypertruck ERX will help get companies to zero emissions faster and cheaper without having to rely on a charging infrastructure that is not available yet. It unveiled its EX bolt-on solution, which is an updated version of its ERX. That provides easier installation, servicing, and operation. This product should be completed by the end of this year. The big concern about investing in HYLN is that the original equipment manufacturers are rapidly developing their own Class 8 EV trucks. These OEMs are established truck manufacturers that have dominated the industry for decades. In addition, leading EV car makers are also looking into this market as well. In order for Hyliion to grow and scale, it needs to partner with a Class 8 truck manufacturer to offer its product as an add-on option. That may not pan out as the OEMs are working on their own EV products. This company's stock surged to $50 last fall because President Biden mentioned his plan to achieve zero emissions by electrifying public transportation. These sentiments were a huge boost to all EV stocks last year. Hyliion stock is down over 80% from its high point last year. It is currently trading below $8. This company was funded by a SPAC, a special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. In October of last year, the merger was completed. Hyliion received $560 million in cash proceeds. The company is headquartered in Cedar Park, Texas, and was founded in 2015. It trades on the New York Stock Exchange. Let's get started with the model. This is a small cap company, 1.3 billion market cap. They're trading at $7.66 a share, and they have 173 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So of course they have negative free cash flow each year since they're still pre-revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses, which is also negative each year. This is the company's income statement. The top line is the revenue, the sales, and they haven't made their first sale yet, so it's zero each year. Below that is their operating expenses, and that's gone up from 12 million to 22 million to 56 million in the trailing 12 months. Here's a breakdown of their 2020 revenue according to their 10K. 12.6 million from research and development. This is the cost to research new products. It's the cost of labor, cost of supplies, cost of machinery. Then you have selling, general, and administrative expenses of 9.6 million. This includes payroll, marketing, rent. They paid 1.9 million of interest on their debt. They paid 3.3 million in 2019 and 5.5 million in 2020. So it looks like they're reducing their debt load. And the bottom line of the income statement is their net income, which is negative every year since they're pre-revenue. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. And then you have capital expenditures, which are investments in property, plant, and equipment. They spent $1.2 million in CapEx in the trailing 12 months. I do expect CapEx to increase a lot in the future as they get more sales and start production. Operating cash flow minus CapEx gives you your free cash flow. And they were running their business on debt, $17 million in 2019 and $4 million in 2020. They received that huge cash injection last year, so now that's what they're going to be running their business on. This is the equity section of their balance sheet. They have $608 million of equity. They raised $373 million from selling their business, and they profited $235 million from running their business. This $608 million seems pretty close to the cash they received from the IPO. I don't understand why they have positive retained earnings since they're pre-revenue and they have negative net income every year. It seems like these two numbers should be an additional paid in capital and they should have a negative in retained earnings. Let me know in the comments if you know why they have positive retained earnings. Maybe these are the earnings from the SPAC that acquired this company? Let's look at the capital structure. $609 million of equity, $10 million of debt. So they're 98% equity, 2% debt. Their net debt is negative $448 million. This means they have $458 million of cash on their balance sheet since they have $10 million of debt. Net debt is your total debt minus the cash on your balance sheet. And I gave them a WACC of 12%, even though the highest WACC at Finbox was 8.5%. It just seems a little more risky, this stock, since there's been a lot of reports that the company may not be getting the revenue they expected to get in the next few years. And that's a discount rate we're going to apply to the future cash flows. We estimated 5 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 5, that's $2.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.4 billion. We divide that by 173 million shares. And we get a calculated stock price of $8.30. They're trading at $7.66, so they're trading at an 8% discount. It's a buy according to the model. Here's one of the company's presentations where they project their future revenue. They said they would have $1 million by the end of 2020. They didn't have any revenue by the end of 2020. But they said they would have $8 million by the end of 2021. So I put $8 million in 2021. Same thing for 2022, 23, and 24. I put the revenue they projected. In 2025, I just put 10% more than 2024. Of course, they may never hit these revenue numbers. If they don't hit these targets, the stock will probably go down more. But if they do hit these targets, the stock will go up a lot. In order to get $8 million of revenue in 2021, they have to sell 300 units. Also in their presentation, they say they secured a 300 unit reservation from Detmar Logistics. And when I went on Detmar Logistics' website, one of their pictures was Hyliion's trucks. So this does seem like a promising order. I assumed the company would have negative free cash flow until 2024, since they're going to be marketing a lot and building out their product line. But then a positive by 2025, and the average company converts 10% of their revenue to free cash flow. So that's how I got their future free cash flows for 2025. 2 analysts priced this stock and the average price target was $8.50. Before a SPAC acquires a company, it's just a shell and it trades at $10 a share. So you can see it was trading at $10 for several months. And then when the company announced they were going to acquire Hyliion, that's when people started buying the stock, and it got way up there to over $50 a share. But then there's been a big sell-off and the stock came down a lot, below $8. Just this week, the stock went down a lot again because of a UBS report. UBS cut its rating on Hyliion to sell from neutral on concerns about its delayed go-to-market plan. The price target for this UBS analyst is now $5. It used to be $14. And he wrote that he no longer expects the company to meet revenue expectations for 2022 through 2024, which had been a key driver for its valuation. The company has taken longer than expected to hit its go-to-market milestones, undermining confidence in the management team's execution. The stock is trading close to its all-time low. It's down 64% in the past 52 weeks, while the S&P is up 31%. The low is $7, the high is $27.30. And the stock is trading well below its 50-day and 200-day moving average. 2.5 million shares are traded each day on this stock. Of the 173 million shares outstanding, 112 million are on float, 26% are held by institutions, and over 20% of the shares on float are shorted. which is equivalent to 14% of the shares outstanding. The short percentage was under 4% in the beginning of the year, but it's really gone up. The shorts have come out in droves on this stock. They think this company will go bankrupt. The stock price is at its lowest point, but the short percentage is at its highest point. A good sign for investors is the employee count is increasing. In the beginning of 2020, it was about 55. At the end of 2020, it was 91. We will not know their 2021 employee count until they release their 2021 10K, which is in February of next year. If you invested $10,000 into this company when it started trading at a SPAC, you would have lost 20% of your investment. The last two insider activities were big sells from Alexander Jenkins. In June and September, he sold a total of 3.5 million shares. He sold for over $12, so he's pretty happy right now. The really young Thomas Healy, I think he's 28 years old. He's the founder and CEO. He owns 20% of the stock. The next holder owns 5.5%, then Vanguard, BlackRock, and Axioma Ventures. Let's look at their financial ratios. We can't look at the PE since they have negative net income. We can't look at the price of sales since they have no sales. They do have a good price to book since they raised so much cash from the IPO. They have a really high current ratio and quick ratio. They have $458 million of cash on their balance sheet. The company seems well capitalized. They had negative $42 million of free cash flow in the trailing 12 months, $447 million of working capital, so they have over $400 million of funding. They should be able to get through the next few years without adding any debt or equity. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 10 companies in the same industry as Hyliion, and if Hyliion has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So we can't look at their PE or price of sales, and they're a pretty small company, 1.3 billion market cap. The average is 11 billion. So to summarize, I have them trading at an 8% discount. The stock has come down so much, so it seems like a decent value at this point. But the company needs to start making products and bring in revenue. And as you know, there's a lot of competition in this industry. If you feel really confident about their products, then it's a great buy. But if you're not so confident about what they make, then I would hold off. I rank their free cash flows, revenue, and ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.